I'm speaking with Teiki Benveniste, Managing Director of Ares Australia. First of all, Teiki, it's a great pleasure to have you here participating in the Inside Network's Income and Defensive Assets Symposium.
Well, it's been great. Thank you very much for having me here, and great to be back, actually.
Good. Teiki, how do diversified credit strategies help investors navigate higher interest rate environments?
Yeah, that's an interesting one. I think most of what we invest into when it comes to our diversified credit strategies have floating rates. So as interest rates go up, naturally those instruments see the income generation, their coupon, go up with higher interest rates, which basically gives you access to higher levels of return without necessarily experiencing the same volatility as fixed rate bonds, where their coupon was fixed at issue, and then the price has to adjust as interest rates go up. So I think being able to lean into that part of the market, which is floating rate, senior secured, really helps in the higher rate environment.
What role does private credit play in your multi-asset income solutions?
Yeah, so what's interesting when you look at direct lending and private credit in general is that it's usually floating rate. And when you think about that floating rate, that means that the income they pay, there's a base rate, which is the cash rate, and then there's a credit margin on top of it. Well, when you look at that credit margin, private credit, direct lending tends to have excess yield. It tends to have a bigger credit margin than comparable liquid credit instruments, and therefore overall direct lending in a diversified portfolio can be used as a yield enhancer, generate higher levels of current yield in a diversified portfolio.
How do you manage allocation shifts between the public and the private credit sectors of your universe?
So I think private credit is oftentimes used as an engine, an anchor. So it's going to be over cycles, it's generally going to be at least 50 to 40% of our portfolios because they just generate that excess yield consistently. But in times of dislocation, what happens is that liquid credit market sees the available current yield or the price of those credit instruments becoming really attractive. And so what we do is that we shift the portfolio to take advantage of those dislocations when we see that happening in liquid credit markets.
How do you address the liquidity considerations when recommending these strategies to advisors?
When we think about the management of liquidity at a portfolio level, we want that liquidity to come from tradable instruments. So, for example, if we're building a portfolio where we're going to offer, let's say, 5% of the fund every quarter for redemptions, we're going to want to build a portfolio with at least a year worth of tradable instruments so that you have what I would call real liquidity. Liquidity that can come from investments or assets that you can actually trade every day and generate liquidity from. That way, when we say to investors, we should be able to give you 5% liquidity every quarter, in the back end, we feel like we have ample liquidity to be able to satisfy those requirements.
What trends are you seeing in spread dispersion across both public and private credit markets?
So I love this question because oftentimes you just hear people saying, what are credit spreads doing? And your question insinuates that there are different parts of the credit market, multiple asset classes, and different types of spreads that can operate in different ways at different times, which is why being in a diversified credit portfolio can be attractive because you can play the different parts of those markets and go where you see the best relative value. And so what we're seeing at this point in time is probably the liquid credit markets are starting to look very tight, or they basically are trading at levels that are tighter than long-term averages, which means that maybe we want to be a bit careful there, go up in quality, play defensively, and then anchor our portfolio into the higher yielding parts of the private credit markets, because that does two things. It enhances the yield in the portfolio, but it also exposes you to less of the potential mark-to-market volatility that you experience in liquid credit.
Teiki Benveniste, Ares Australia, thank you very much for your participation and time, as always.
Thank you.